Okay, let's look at short exercise 9-3 in your text. This is where we're going to do some practice applying the direct write-off method to account for those uncollectible accounts receivable. So we have Sherman Peterson, and they're an attorney in Los Angeles. Peterson uses the direct write-off method to account for uncollectible receivables. So remember, the direct write-off method, that's where we don't write them off until we deem them uncollectible, so in the future. It says that January 31st, Peterson's accounts receivable totaled $15,000, and during February he earned revenue of $18,000 on account and collected $19,000 on account. He also wrote off uncollectible receivables of $1,800 on February 28th. Use the direct write-off method to journalize Peterson's write-off of the uncollectible receivables. So here he wrote them off on February 28th, $1,800. So what we're going to do is we'll have February 28th, and we'll have bad debt expense, $1,800, and then we'll directly reduce that accounts receivable account for $1,800, okay? And that was to record the write-off of bad debts. All right, then they asked us what is the account balance and accounts receivables. So here we're going to use, here's a T, a T account of accounts receivable, and it says that they started with a balance of $15,000, and remember the beginning balance, that's a debit because it's an asset. It says he earned revenue of $18,000 on account, so that would increase our accounts receivable by $18,000. And it said that he collected $19,000 on account, so that would be a credit because we're going to reduce it for collecting the cash. And then we wrote off receivables. So this journal entry up here is another credit of $1,800. All right, so the balance on the debit side is $33,000 and the credit is $20,800. So we would take $33,000 minus the $20,800, and that gives us our debit balance of $12,200 in accounts receivable. Okay. So if you have any questions on this, please send me an email or post your question in the discussion board.